Stop. Before you place a single lot on $yen today, I need you to see a trap that is being set right now. Over the last 4 sessions, we witnessed a flash crash, a V-shaped recovery, and now price is magnetically drawn to a resistance cluster that screams one thing: the sell of the week. But here is the twist: the moment that resistance fails, we're not just going to 160, we are testing the historical ceiling at 162, and every short will be annihilated. There is one danger zone and one hidden opportunity today. I will show you both. Stay until the end because I am handing out 3 exact entry prices, the exact stop, and 2 profit targets you can plug into your platform immediately. Session bias. We are leaning bearish on an intraday fading basis, waiting for the momentum to exhaust inside the 159.08 to 159.73 supply zone. This bias is live only while price respects that ceiling. Write this number down: 159.73. That is the invalidation level. If a daily candle closes with conviction above 159.73, the sell-side structure shatters, the death cross trap narrative dies, and we pivot straight into breakout longs with a target at 161.80. Before the close, we scalp the fade. After the close, we ride the momentum. This is the line in the sand. Now let me show you why the charts are trembling. We start at the macro daddy, the monthly chart, because that is where fortunes are made or erased. The long-term structure since 2022 is an undisputed, screaming bull run. The monthly moving averages, the 5, the 10, the 20, the 40, are in perfect bullish alignment. MACD is above 0, but here is the critical nuance. It is high-level stagnant, with histogram bars oscillating flat. This is not fresh momentum. This is a tired bull staring directly at the previous macro high at 161.94. That region, 160.00 to 162.00, is a potential double-top graveyard. Price currently at 158.77 is in a no-man's land between the deep 140 support and that ceiling. Big money is deciding whether to absorb a final push or to distribute into the rally. Until 162 breaks, every long from here is an assumption of a breakout, and every short is a bet on history repeating. Drop to the weekly chart to see the medium-term heartbeat. The recent swing saw a powerful bounce from the 151.70 region, right at the weekly 40-period moving average, which acted as a launchpad to 160.72. That rally failed. Price rolled over, and now we have a weekly MACD that has executed a bearish cross. The fast line is below the slow line, both still above 0, which tells us the medium-term uptrend is mature and bleeding momentum. Price is struggling to hold above the weekly 10-period moving average, which sits at 158.84. Right now, spot at 158.77 is microscopically below that line. The weekly 5 at 158.08 and the 20 at 157.51 form a support band below. We are in a high-level sideways chop, building a structure that will either become a bearish distribution top or a flag before the next leg higher. The tiebreaker will be the daily chart, and this is where the money is made. The daily chart printed a terrifying flash crash in mid-May, a vertical drop that sliced through every single daily moving average and bottomed at 155.02. That collapse was so violent that the 5 and 10-day moving averages plunged below the 20-day, forming a textbook death cross. But bears couldn't hold it. The 155.00 psychological magnet ignited a vicious 4-day rally. That rally has now retraced directly into the death cross resistance nexus. Let me give you the actual numbers so you see why this is a sniper's nest. The daily 20-period moving average is at 158.22. The daily 40-period sits at 158.70. The 5-day, although recovering, is still below at 157.95, and the 10-day is at 157.47. Price today at 158.78 is chewing right through the 40-day and is a handful of pips below the 20-day. This is the absolute textbook retest of a broken structure. The flash crash broke the trend. This rally is the kiss goodbye. If sellers come in here and produce a daily bearish engulfing candle, it confirms the death cross and opens the trapdoor to 155 again. If buyers thrust through and close above the entire moving average knot and the 159.73 high, the death cross fails and becomes a bear trap that fuels a high-velocity short squeeze. MACD on the daily sits below zero with the histogram shrinking, which fits the narrative of a counter-trend rally losing steam. Every major signal is converging right here, right now. Point 1. Additional daily support and resistance mapping. The immediate support is 157.73, which is the swing low consolidation area from yesterday, and below that 157.08, the previous broken structure. Resistance is exactly the 159.08 intraday swing high and the 159.73 structural level. That zone is the kill box. Here is what most traders miss. While you're looking at dollar-yen, you must look left at the Nikkei 225. These two share a heartbeat. Currently, the Nikkei is also testing a local resistance after a bounce, struggling with its own moving average cluster. If the Nikkei starts failing here and breaks below its 38,200 area, it signals a flight to safety, a yen bid, and that sends dollar-yen down with it. Conversely, a Nikkei breakout above 39,500 greenlights risk on and can drag dollar-yen through resistance. This cross-confirmation is my secret edge. Before I pull the trigger on yen, I confirm with the Nikkei 5-minute and hourly chart. If both resistance levels hold simultaneously, the probability of the fade goes from probable to highly likely. The 24-hour news catalyst is a loaded question. How much additional firepower does Japan have for yen buying intervention? This is not a standard headline. This is a psychological weapon. The Ministry of Finance knows they cannot fight the yield differential by selling unlimited dollars forever. They spent over $60 billion in recent rounds, and the effect was temporary. So now they use verbal intervention, creating a ghost that haunts the 159.50 to 160.00 region. Every time price approaches 160, Tokyo officials emerge with "We are watching with high urgency," which injects a risk premium into yen longs. The market is now self-policing. Speculative longs reduce dollar exposure before 160 because they fear waking the intervention monster. That very fear creates the supply that forms a local top. And if there is an actual intervention, it triggers a 200 pip liquidation cascade. So, trading near 160 without accounting for the intervention ghost is trading blind. The interest rate differential between the Federal Reserve and the Bank of Japan remains a chasm. US 10-year yields are holding near 4.4%, while Japan's 10-year is capped below 1% by yield curve control remnants. The carry trade is still fundamentally attractive, which is why dollar-yen cannot crash sustainably unless there is a hard landing in the US or an aggressive BOJ rate hike, neither of which is imminent. Therefore, the 1 to 2 week directional lean is grind lower to wash out weak longs, then a slow grind back to the top of the range, but capped by intervention threats, keeping us in a 155.00 to 160.00 range. The event that would invalidate this thesis and send dollar-yen straight to 163 is a hawkish Fed surprise that widens the rate differential further, combined with complete silence from Tokyo. A daily close above 160.00 without intervention checks that box, and then we chase the moon. Until then, range logic dominates. Most people will skip this, but this is where money is made. Keep watching. I will now give you the 3 strategies. We are naming them the sniper, the active trader, and the aggressor. Take these numbers and write them down. Strategy 1, the sniper, conservative short. This is for the trader who wants a high probability, structure-backed fade at the maximum edge of the range. Your trigger condition is this. Wait for a push into the 159.50 to 159.73 resistance zone on the hourly chart. You do not enter market. You need a confirmation signal, a clear bearish engulfing candle on the 1 hour or a shooting star rejection with a long upper wick, closing back below 159.30. The exact activation entry is a sell stop at 159.25. 1 pip below the confirming rejection candle's low. Your stop loss goes at 160.20. Logic. 160.20 is above the psychological 160.00 barrier, and above the wick that would form if intervention fears trigger a false breakout. It gives enough room to not get caught in noise. If price trades above 160.20, the structure has clearly broken, and you are wrong. Take the loss. Profit target 1 is 158.00, right above the weekly 5-day moving average support, yielding a risk-to-reward of approximately 1 to 1.2 on that half. Profit target 2 is 157.10, just above the strong daily structural support, giving a full reward of roughly 1 to 1.8. Take half profit at 158.00, move stop to entry on the remainder, and let it run. This setup is voided if we open gapping above 159.75, in which case you stand aside and switch to the breakout script, strategy 2, the active trader, standard short, mean reversion. This is for the trader who sees the death cross retest and wants to play the rolling resistance of the moving averages themselves. The entry condition, price rallies into the 158.90 to 159.10 band, which is the intersection of the descending trend line from the 160.72 high and the daily 20-period moving average. Your sell entry is at 158.95, entered as a limit order with a split trigger. You can also wait for a 15-minute bearish engulfing to confirm. The stop loss is tighter at 159.45, which is just above today's expected high and above the 159.08 swing resistance. The logic is that if price powers through 159.45, the intraday momentum is too strong, and the death cross retest is likely failing. Stop out. Profit target 1 is 158.20, which is today's VWAP and the daily 20 MA itself, a quick scalp. Profit target 2 is 157.45, below the 50% retracement of the flash crash recovery, a meaty runner. Once target 1 is hit, move the stop to break even. The risk-to-reward is roughly 1 to 2.5. This setup exploits the rejection of the daily moving average dead zone. It works best during the London or early New York session when liquidity surges. Let's see how aligned we are. Type your US dollar to Japanese yen range for tomorrow in the comments right now. I'm reading them, the high and the low you see. I want to see if you've got the same numbers I do. Drop. Then below, strategy 3, the aggressor, high-risk breakout long. This is for the trader who believes the flash crash to 155 was a massive institutional stop hunt and washout, and the real intent is to take out 162.00. Your activation condition is the exact opposite of the fade. We need a daily candle close above the 159.73 invalidation level. Not a wick, a full 4 p.m. New York close body above 159.73. The entry is executed on a pullback the following session. After the breakout close, wait for price to retest the 159.20 to 159.00 zone, the former resistance turn support. Place a buy limit at 159.15. The stop loss is 158.40, which is below the daily 20 and 40 moving averages that would be recaptured as support. If it breaks back below 158.40, the breakout was a bull trap, and you exit. Target 1 is 160.70, the prior swing high. Target 2 is 161.80, just ticks below the multi-decade macro resistance at 161.94. The risk to reward on this is aggressive, roughly 1 to 2.1. Explicit warning, this is a counter-trend trap breakout play. Only for those who understand that breakouts above multi-year highs often reverse violently, and who can accept a full stop-out without emotional damage. If the Bank of Japan intervenes verbally at the New York close, this setup is invalidated. Move to flat. Never risk more than 1 to 2% of your account on any single trade. No positions through high-impact news events like US CPI or an unscheduled BOJ rate statement. Stops are non-negotiable. The difference between a funded trader and a statistic is how they treat the red line. Respect the 160.20 and the 158.40 stops, and you will live to trade another day. If you remember nothing else, remember 159.73. That is the pillar that holds up the entire next week. A daily close below keeps the range-bound fade alive and targets 157.00 and then 155.00. A daily close above unleashes a breakout that will likely test the 162.00 region and force the BOJ's hand. Tomorrow we have the US Services PMI and a slate of Fed speakers. Any hint of a hawkish pause will spike dollar-yen, and I will be right here breaking down whether the breakout is real or another trap. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Check the end screen and watch the risk asset shadow fall. Smash like if this analysis gave you a clear plan for today's session. Subscribe and hit the bell for daily institutional grade coverage of 8 key assets. I'll see you in the next one, where we decode whether the liquidity tide is turning.